honestly, well, I studied. Okay. Morning, clients and trading reps. Welcome to this week's morning market call. We're going to talk about markets, but we're going to concentrate more today on a new call, Heng Heavy Machinery. So I will start, and then Kenneth Cole will talk about Heng. Little disclaimers. Okay. Is the equities bull market still on? We still think it is. Our broad call is still the same, long equities. The macro trading calls now are long equities, long commodities, short gold, and short U.S. Treasuries, which we released a report 1 week ago advocating these, and I will touch on them again. Okay, U.S. economic fundamentals keep getting better. Forward-looking core business investment is robust. That is this chart over here. You can see the rebound is very strong. The employment situation is on a very steady trend despite July's below expectations print. So when you look at economic data, you should always even out the month-to-month volatility. So we tend to look at 3-month moving averages and 12-month moving averages. So as you can see, for the employment, despite a weak July print, it's holding steady and not turning down yet. Now, the U.S. trade deficit is also narrowing because of the shale energy boom, and the government budget deficit is also narrowing. Okay, so despite the sequester, I think we have to be pretty satisfied with U.S. Economic data, chugging along steadily despite the budget cuts. And of course, the boost in the trade deficit, the narrowing trade deficit will obviously add to GDP as well. Okay, so U.S. corporate profits are also trending higher, as you can see here. This the blue line, 12-month moving average of U.S. corporate profits tends to, this trend will tend to correlate quite well with the S&P 500, which is the blue line below. So you can see when it starts to turn, when corporate profits start to turn, that also signals that the bull market is going to end. However, we have not had that yet. Okay, so U.S. economic fundamentals are pretty good. Corporate profits trending higher, likely to guide the S&P 500 along with it. Now, China's slowdown has bottomed out. So this indicator here is the year-on-year changes, smooth year-on-year changes for volumes shipped and freight volume shipped, volume shipped from the manufacturing sector, industrial sector, and also transport volume shipped. Okay, we have this. If we look at all the volumes that are being moved, actually more goods are being moved at this point in time compared to last year. Now, China CPI is also pretty subdued, so not much risk of interest rate rises. Industrial profit is also starting to turn, and the CSI 300 made a weekly double bottom, and valuations are extremely cheap. So last week we came out saying that you should buy the 83188 ETF, .Hong Kong ETF, which is a physically backed ETF if you want to long China. Generally, there's a global rebound on the cards. Eurozone PMI is rebounding, Japan PMI is rebounding, and the global average is also rebounding. Already the G4 are all starting to pick up, and that is 75% of global output. There will definitely be spillover effects into Asia and into ASEAN. Okay, with global growth on rebound, we believe that commodities are starting to break out. As you can see that there's this downward sloping trend line, and we have had a couple of weeks move above that trend line. If you want to long commodities, that's with the GSG.US ETF. And also the macro picture is generally bad for gold, so you could also short gold. U.S. growth is picking up. As we said, trade deficit narrows, government budget deficit narrowing, corporate profits trending higher. All these basically mean that the dollar is going to strengthen. Okay, so what for hold gold in our opinion? Also in a strengthening economic environment, and also as Kenneth Ko has been saying many times in the market analysis slides over many weeks now, it is a long stocks, long commodities, and a short bonds environment. As you can see, Asian bonds have been in a steady decline this year, and also U.S. bonds have been in a steady decline. Okay, so the previous slide was in terms of price, but here we have it in terms of yield. So rising yields basically means lower prices for bonds. Okay, and I think, oh sorry, and if you want to short the U.S. market, U.S. bond market, the ETF TBT is an instrument to use. Now, the Straits Times Index, also we think that the bull market is not over yet. We have had a test of the trend line here, but not broken. Now, SG corporate earnings are also starting to rebound. Okay, so we're still positive on the STI and generally positive on stocks. Now, moving on to our stock call of the week, Heng Heavy Machinery.
Hi, yes. I'm Kenneth. I'll talk to you about Heng Heavy Machinery. This is our stock of the week. Okay, so here you see owner Tan Lai. He's the founder of Heng. 40 years experience in the business. This is his son Don, who's also the CEO. These are also his two sons. Okay, let's go in. Okay, this heavy machinery company. I call this poised for success when no one was looking. So we'll talk about the formalities, the synergistic business model, the regional growth opportunities, and the attractive valuations. I set a target price at 27 cents, which is a 25% upside from today's price of 22 cents. Okay, let's get started. Okay, in a nutshell, this is the profile in a nutshell. So this core businesses are cranes and aerial lifts. Okay, they do rentals and trading. So it's a crane rental and trading company. Okay, a big portion, 50% by revenue, is in the Singapore market. Okay, but they have long-term relationships with clients and they're expanding to Asian regions, as you see over here. Next highest is Indonesia by revenue. Okay, so they're acquiring specialized equipment to sustain competitive advantages in terms of efficiency and service excellence. Okay. Well, today we're going to see that this is not your average crane rental company, and I hope to show you why. Okay, investment merits in a nutshell. I'll go through these in detail following later on in the presentation, but this is what I want to say about this. I believe it's a resilient, efficient business model. It has the best financials and valuations of all peers with growth prospects. Okay, we believe that the business model is actually very competitive and that the rental and trading arm of the company is actually synergistic and very unlike the rental and trading arms of its peers. Okay, this company, Heng, is actually one of the largest market players in crane trading in Asia. It has a long history of being in the crane business, 40 years. It is endorsed in the sense that Toyota Corp, okay, has actually acquired a 27% stake in the company. Okay, and the company is actually a major dealer and distributor of Kobelco, Kato, and Mighty Cranes. These are reputable Japanese brands. Okay, we will see that margins have bottomed, okay, and stabilized, and growth drivers are in place. This bodes well for the future. They are also well capitalized for expansion because they just finished a rights issue in June, where they raised $17.9 million for themselves. You'll see that they have increasing earning trends, and they managed to do this with less leverage than their peers. Okay, yeah, the regions they operate in have ample opportunities for infrastructure for the next few years. This bodes well for them. In a nutshell, a relative valuation is that enterprise value over EBIT, okay, is 6.3. Okay, enterprise value is simply market cap minus away your cash, your net debt, that is. So you add your net debt divided by, sorry, the enterprise value. Okay, it's 6.3 versus peers 9.9. Okay, it's diluted PE for 12 trailing months, 8.8 versus its peers of 10.9. So by both valuations, Heng is actually performing at better valuations than its peers. Okay. Oh, did I also mention that their assets, as in the cranes, that it's actually movable and monetizable. So it gives you some added security in this investment. We believe it's a good time to get some. Okay. Okay, the formalities, very quickly. Some of these slides I will go through very quickly, and I have to leave it to you to look at them yourself so as to save time. Okay, but essentially here is the corporate data. Its market cap is not that small, 120 million. Okay, and essentially for last quarter, okay, or rather for FY 2013, they've done pretty well. As you can see, revenues and profit have both increased by 40+%. Okay, that makes a current PE for 12 trailing months 7.3 before the rights dilution and 9.0 after dilution. Note that in their balance sheet, the cash from the rights issue have not been factored in yet. That's why I put in two values for PE, so you know what their effective performance was. Okay. Here's a core business. They have a equipment rental and trading arm. Okay, so essentially for rental, they rent cranes and aerial lifts for a wide range of uses for various industries, such as infrastructure, construction, offshore, marine oil and gas, to even golf competitions. That's when they use the aerial lifts. Okay, the projects can go on a monthly, weekly, or daily basis. And Heng also provides turnkey project engineering services on advising on the lifting plan and operations. Okay, to complement crane rental services. Okay, for trading, they are actually a leading supplier of new and used cranes and aerial lifts. They have established a network of suppliers, including original equipment manufacturers such as Kobelco, Kato, and Mighty Cranes. Okay, and their distribution channels span very many regions. A quick snapshot by revenue. You'll see that 71% by revenue is from trading and 29% is from renting. The gross profit, however, is switched because renting has much higher margins than trading, although trading is much less capex intensive and doesn't strain the balance sheet as much. Here are the cranes that they offer, a wide variety of cranes and different tonnage and aerial lifts. Okay, this just shows you how year by year they've increased their crane tonnage according to their growth plans, so that's good. I just also want to point out that Heng boasts one of the youngest crane fleets of mostly Japanese cranes. The average age of all their cranes is less than 5 years, which is the significance of this I'll touch on later on. You'll find that they're one of the most experienced crane operators / business in Singapore. Even going back to 1980s, they've been a part of all the most iconic projects, even the Benjamin Sheares Bridge. Okay, corporate milestones. You can mull over this after the presentation. Just want to point out, but since 2010, they've had a growth plan and they've faithfully kept to it. 2010, they were awarded Kobelco distributorship, Kato dealership. 2002, they established a subsidiary in Myanmar and Indonesia as well. Here are their global networks. Singapore is in yellow, Malaysia and Vietnam is in blue. This is actually from the 2012 annual report, so it's missing Myanmar. Oh, actually it's here. This should be blue right now, actually, Myanmar. But anyway, for these regions, Singapore, Malaysia, Vietnam, and Myanmar, that's where they have renting as well as trading. The regions in red are essentially their trading networks, where they do primarily trading. As you can see, the trading arm is very expensive. Here's a corporate structure. Okay, so before we go on to the actual business model and what makes it unique and competitive, let's look at a quick look at the peer snapshot. just to show you how they've been performing compared to their peers. So of their 4 peers, this is the other 3 companies they're commonly compared with, Tat Hong, Tiong Woon, and Help Dong. Some things to note. One thing that's obvious is that Heng has a tendency to just operate much more efficiently. Historically, they've always been in the utilization rate, a crane utilization rate of 85 to 90%, and that exceeds essentially the average of all their peers. What's not here is also for their trading inventory turnover. It's actually very healthy at 27 days, and you'll find that their business model has a great deal to play with why they're performing so well. Okay, besides the better utilization of cranes, you also note that besides competing in Singapore, because all these operators compete in Singapore, they actually compete, or they are concentrated in different regions outside of Singapore. So they almost have a little bit of their own niche outside of Singapore. For example, in Indonesia, Heng has a big presence there, a trading presence there, but you don't see that in the rest of the firms. Just as Tat Hong is big in Australia, and you don't see that in the rest of the firms as well. Okay. Next thing to note is this. This is very key. Net debt to equity. Heng has been able to get to earnings and valuations of 6.9 before dilution, 8.8 after dilution. It seems comparable to the 9s and 9.4s, but note that Heng has been able to do that with much less debt, virtually almost net debt of almost 0, whereas the rest are at least an average of 50% levered up. Okay, this is key in their performance as well. Also, once you take that into account, we like to look at this ratio, enterprise value. This should be EBIT, not net earnings. But in any case, you do see that it does, the ratio does outperform the rest, and much better valuations. The question is why. Okay, to answer why, let's look at the business model. Okay, this is the business model. Essentially, I find that there's 4 main components. You have their rental arm, you have their regional trading arm, okay, and then you have its partnership with Toyota, as well as its distribution dealership with Kobelco and Kato. I believe these 4 come together to give synergy and efficiency. Well, how does it work? Essentially, Heng has a plan to keep their fleet young, of less than 5 years. Okay, and how they do that is they essentially sell all their used cranes or older cranes very efficiently through their very active networks, sales networks. Okay, and then once they sell their old cranes, they can basically buy new cranes from Kobelco, Kato, or Mighty Cranes. So this helps them to keep their fleet young, but the important thing is the sales network allows them to do it efficiently. Why is that key? In developed countries, it's very key for clients to not have any downtime in their projects. If a crane actually goes down in a construction project, it can go down for weeks. And of course, most developed clients would not want that at all, and they would probably pay a premium to have essentially the best fleet around. And this is where Heng shines. So by efficiently getting rid of their older cranes, they can boost a younger fleet, which is more reliable, and hence get such clients. At the same time, the older cranes can be used to be rented or sold in the rest of the less developed countries, as less developed countries usually have lesser standards in what cranes they use. Okay, so the net effect of that is that, so here's where you get an efficient young fleet of less than 5 years. Okay. Also note that a testament to the type of clients that Heng gets, okay, are quality clients. The amount of bad debts for the last 15 years is only 50K SGD. This is quite nothing compared to the millions that they make every year, as a testament to the type of clients that they get. Okay. Oops, clicked the wrong thing. Sorry, here. Okay. For Kobelco and Kato, these are actually reputable brands. Kobelco is actually ranked 13th of the top global construction manufacturers by revenue. Kato is ranked around 30. Okay, the synergy of this model here, I guess what best testament to it is just the results. And you can see that since the end of 2011, trading revenue has increased by 80% and rental revenues have increased by 60%. Okay, margins have been stable since FY 2011, which I'll show you later. So this does bode well. It's a testament to the business model. And finally, for Toyota, the benefit they get is that now with this this big company with resources and networks, that's what they provide to Heng. Okay, so there's just more resources, data, intel, and opportunities to drive this. Okay, so what does that mean? Okay, the effects you get is this. You have increased flexibility of fleet and resource management, increased holding power to ride out cycles. By cycles, I mean that if you have cranes, you can essentially rent them out until the cranes appreciate in price, and then you can choose to sell them. Okay, the increased ability to get involved in the region. Essentially, if you can't rent, you can always sell, since you have both trading and rental arms. Okay, finally, that leads to these valuations that we talked about earlier. Okay, authorized dealerships. Okay, Kobelco, Cato, and Mighty Cranes. Here's when they were authorized. Okay, so just some data on Kobelco and Cato. So Cato is actually ranked 36, but rose by 2 ranks from last year. So it shows you that the popularity of these cranes, they're pretty good. Operational efficiency, we have touched on this already. Okay, so here we see their revenue patterns and the earning patterns. So purple is rental and blue is trading. So as you can see, since 2011, okay, margins have stabilized. The reasons why trading and rental margins have dropped was because of oversupply once the IR projects in Singapore was over with. During the IR construction times, business was booming and basically all crane companies were having much bigger margins. But since the completion of that, margins have dropped, but now they seem to have finally stabilized. So trading has stabilized, and as well as renting as well. But what we see is the effects of their growth plan. You can see that rental revenue has steadily increased year on year, and so has trading. Okay, revenue by regions once again. Okay, here's just a breakdown. I won't go too much in detail, but let's just talk about. But here's a summary. So essentially, these colors are each individual region. Okay, this long blue, dark blue is just the total revenue, and this is just the net profit over here. Okay, and this is the net profit margin. So as you can see, since 2011, net profit margins have stabilized. Okay, and it's going on an uptick. Now, the summary is this. So essentially, from year to year, 2012 to 2013, all main regions improved in revenue and margin. Malaysia's growth plans according to plan. Please note that they started ramping up activity there only 2 years ago. So this growth is actually really good. Okay, similar growth is actually expected this year. Myanmar's growth is also considered excellent because even though Myanmar revenue is only clocks in at 1.3 million, but just remember they only just started less than 3/4 of a year ago. And this growth rate is expected to continue this year and next year. Okay. Okay, regional analysis. To give you a color of the infrastructure, the amount of infrastructure projects that are available in these regions, I've listed it down here. But this just to show you that in Singapore, there will be a stable amount of infrastructure going on. Okay, this year might be a little bit of a lull, but it will pick up in Q3 and Q4. Just note that the Business Monitor International estimates growth in Singapore construction sector to reach 6.2% this year and 3.7% for the next couple of years after that. So there will be a steady pipeline of construction projects for Heng to bid for. Okay, for Malaysia, even though there may be symptoms that the construction cycle is turning, but the government itself has already announced $160 billion, okay, RM 160 billion to be spent on rail-related projects until 2020. So once again, even in Malaysia, there will be a pipeline of infrastructure projects as well. Okay, for Indonesia, maybe we should talk about this a bit more because of the recent currency devaluation. Well, the recent currency valuation might have two potential effects. The first one will be, a weak rupiah can cause a drop in demand due to inflation, rising prices. Of course, if the government tries to control inflation by raising interest rates, then businesses cannot borrow cheaply. It will slow down growth. Okay, so we have inflation and slowing down of growth as a concern. Okay, but when we look maybe closer at the scenario in Indonesia, it's not as bad as we think, because most infrastructure projects are actually still ongoing. Management has guided themselves that all the projects that they are involved in are still ongoing. Okay, but not only are they still ongoing, but the president had already stated that they would prioritize infrastructure construction next year. So once again, there will be a pipeline of projects to bid for. Okay, now about currency. For currency, even though the rupiah is weak, and so there's concern that potential clients might hold off their crane buying because the cranes are in Japanese, so it's in yen. However, this effect of the weak rupiah is actually buffered or muted because the yen has also dropped 20% in the last 2 years. So net-net, the IDR cross Japan is actually only slightly less than its 5-year median price. You can't see the chart symbols, but this is the IDR cross Japan. You can see its high is here, 1.05 around there, and its 5-year low is here, about 0.75. Right now we're about 0.87, which is just slightly less than its median value. Okay. So the devaluation of the IDR has been muted because the yen is also weakened. Well, conservatively speaking, what we can say, I guess, is that for trading in Indonesia, there'll probably be a volatility of revenue, but the longer-term future is promising due to government commitment for infrastructure spending. Okay, and of course for Myanmar, we all know that there is much prospects there as they just open their doors and with economic reforms. Already, even though they started about half a year ago, Heng has already managed to have a 100% utilization rate for 5 cranes in just half a year. Okay, this growth rate is set to continue, if not accelerate. So this is one exciting growth center for Heng. Okay, so we talked about regions and the stable pipeline of jobs that they could have. Let's talk about valuations now. Okay, if you look at this table on top here, this just gives you the relative valuations for Heng versus its 3 other peers. So some things to note is that undiluted PE is less than its peers. Okay, average is 9.8. Here's the undiluted PE. If you choose to dilute the PE, this is the new values. Heng is still undervalued on this matrix, except not so severe as this one, simply because once diluted, Heng takes the effects of dilution, but it's flush with cash compared to the rest of its peers who are actually quite levered. Okay. More importantly, over here, enterprise value over EBIT shows the whole story because enterprise value takes into account net cash and debt. And you'll see that when you look at this particular matrix, right, Heng is actually very much superior than the rest. Okay, so I evaluated this 5 different ways. So let's look at the first one. So although Tat Hong is bigger, I believe Heng's track record, healthy balance sheet, successful business model, and growth prospects should deserve a PE at least equal to Tat Hong. Tat Hong did not execute well this quarter, actually this year. Okay, we should use the undiluted one, okay, because I believe that Heng is in a good position to put their cash to work. They've had great utilization rates, great sales turnovers. There's no reason why they can't put their cash to work for future earnings and expand. They can expand by increasing their fleet, or they could even do M&As, okay, depending on where there's opportunity. So based on this, if you peg it to just Tat Hong's PE of 9.1, that gives you a target price of 27 cents. Okay, and that's just if you peg it to Tat Hong's PE. If you peg Sin Heng to the average peer PE of 10.9, that gives you a target price higher of 32 cents. Okay, these two don't really take into account of debt very much. So if you look at enterprise values instead, you find if you peg it to 8.8, which is the second best performer, you'll get a target price of 30 cents. If you peg it to the average, okay, of the peers of 9.9, you get a target price of 34 cents. So now you have 4 valuations and the lowest is 27. Okay, here's his own relative historical valuations. Okay, let's focus on this one over here. If you look at its own enterprise value over EBIT cycle, you see that it is at, once again, its standard deviation low. Okay, so it's good timing right now. Okay, so the cycle is at a low of 6.5, which is way under the average of 9.0. So if you assume that this can normalize back to 9.0, then you will get a target of about 31 cents. Okay, so with the 5 different methods of evaluating, you have these over here, and I'll just take the most conservative one of 27 cents as my target. And this is 25% upside. Okay, I believe this is conservative. Okay, because I took even 12 trading months as my earnings instead of just recent Q4 annual earnings, because the recent quarter Q4 really had a higher growth rate than the quarters before it. Okay, won't be complete without the technical outlook. This was the chart of Sin Heng as it was ended last week, and as you can see that the price has been on indecision on this 200 MA. Now, this is a key resistance level, this moving average, but the next key resistance level is actually at 22 cents. 22 cents is actually the next key level, and you can see if I draw a line across here, it crosses this whole breakdown pattern over here. So it's key. Interestingly enough, if there's enough power for price to blow past 22 cents, it should not have too much of a problem reaching 24 to 26 cents. Okay, are there indications that this might happen? Well, prior to this consolidation, we had this semi-bullish candle here on heavy volume, which bodes well. Okay, the MACD is almost going to cross over here. And if this breaks through, it's going to break through not just the MA, this resistance, but also this trend line. So we should look at this position to see if there's a breakthrough. Now, I believe there are enough fundamental reasons for it to break through this level. So we should definitely keep an eye out for this. Okay, just a quick summary for your viewing pleasure on Sin Heng. Risks involved, okay. So once again, let me just talk about the investment merits, right? So we have a synergistic trading and rental model, okay. This led to quality earnings with lowest leverage. You have the endorsement by TTC, Cobalco, and Cato, okay. The biggest regions of operations have stable infrastructure activities going on. You're well positioned with a stable base in Singapore and has initiated growth prospects in Malaysia, Myanmar, and Vietnam, and we've seen the fruits of these already. And Sin Heng is also better capitalized than peers to take advantage of any regional weakness. Okay, risk would be main contractor bankruptcies. Okay, and unexpected crisis in operating regions. These will both impact revenues, future revenues, and present revenues as well, and margins. Okay, thank you. Okay, questions please. Okay, here's a few questions on Heng, which I will answer. Okay, let's see. Does Heng buy machines from Japan using SGD or JPY? Heng actually uses SGD to buy cranes. They accept USD from their clients when they sell cranes. How many authorized dealers Kobelco and Kato have in Singapore? I don't know the exact number of authorized dealers, but I can tell you that Heng is the #1 buyer of Kobelco cranes. So majority of Kobelco cranes actually go to Singapore. Okay. Heng, should we enter at current price or wait for it to break at above 22 cents? Based on fundamentals, I would say getting in at 22 cents is a good price to get in. I think now is a good time to get in for Heng. What is Heng's gearing? Heng has a net debt to equity ratio of 3%. So this net debt to equity ratio also takes into account the $17.9 million from the rights issue, because in their last quarterly results, the rights issue cash is not reflected on the balance sheet. So actually, to get its true net debt, you must add in the cash from the rights issue. So once you add in the rights of the rights of the issue, you're going to get 3%, and that is a great contrast with competitors who are between 40 and 60%. So if the competitors want to expand, they will have to raise cash somehow. Okay, next question. How much is Heng's business in Myanmar? Okay, Myanmar, they only started essentially slightly more than 6 months ago. And in that 6 months, they have generated revenues of about I believe it was 1.6 million. Okay, this is actually very encouraging, and management actually believes that this growth rate will actually increase next year, because right now because they've got their 5 cranes in the middle of the city. Now everyone is actually calling them up for queries. So Heng's business in Myanmar, although small, is on a good growth rate. Okay, I've got a question here. Any geographical breakdown on rental business in terms of revenue and profit? Okay, unfortunately, Heng doesn't publish the breakdown in a particular region in terms of rental and trading. They only give it to you in full, how much trading and how much rental, or in terms of regions. But I can tell you as a guide, it is in those regions is about 70% revenue on trading and 30% revenue on rental. That's just my best guess. Do they issue dividend? Typically, for the past 2 years, they've issued dividends of between 4 and 5%. Believe this year will probably be the same as well. Okay, here's a question that says, I realize there is no forecast of financials and various valuation ratios for FY14 and 15 in the research report for Heng. Have I missed out? No, you actually haven't. This report that we rushed out to you is actually a trading buy. So basically, it includes essentially all our reasons for buying the stock, except for the FY 14 and 15 actual projections. However, I put down all the reasons why I believe there'll be chance for growth in FY 14 and 15. Okay, I believe FY 14 will have a little bit flat growth, but you will see a great increase in growth in FY 15 for two reasons. One, um, in quarter 3 and 4, Singapore's there'll be an influx of new projects for infrastructure in Singapore, and also right now in Myanmar and Malaysia is infancy stage. So now the company is investing money for setup costs, and once you absorb these setup costs, right, you will see the rewards of this expansion next year. What is the floating rate and the percentage of family major shareholder? Okay, Heng is owned by family, but it's around 28%. Okay, so 28% is by the family, 27% is by Toyota, Tusho Corporation, and the rest more or less is float. So that's 28% family, 27% Toyota, and the rest is float. Why I did not in China? For the very simple reason that this CEO only goes into regions that he's very comfortable in. That's the reason why he's got utilization rates of close to 90%, great sales turnover, and bad debts of only 30K for the past 15 years. He only goes into regions he's confident in. And don't forget, in Myanmar, Heng is actually the first mover there. He got there way before any of his peers did. So he felt he had competitive advantages in Myanmar, so he went there first. There's more questions, macro questions.
Hi. Okay, macro questions now. There's a question here asking if the correction in the US and Singapore market blown over. I think our opinion is that there's a good chance that it has blown over. I think technical indicators are not totally there yet, however, but fundamentals-wise, we see great improvement in the economic outlook, especially with G4 countries performing well. And there's bound to be some spillover into ASEAN nations. So I would say if you want to step in, then developed markets, US and Singapore are better chance that it's blown over. Now ASEAN markets, maybe it may not be totally blown over yet because there are still macro concerns in Indonesia, Thailand and Malaysia. However, our opinion is that the concerns, which are mainly now growth concerns because of interest rates rising, actually those concerns may also soon enough blow over because there's bound to be export boosts for these countries, given that the G4 is actually improving. Okay, there's a question here on the Federal Reserve. What's your take on what the Fed will do to the monthly QE amount and how much will there be change, if any? I think they'll probably still reduce it from 85 monthly billions of monthly purchases to somewhere around 75. And I think they will gradually taper this down to zero by the end of next year. I personally feel that the end of QE probably is actually going to signal the start of a stronger economy, and that if there's any downside volatility, it will be an opportunity to buy. In fact, we may have already priced down that downside by now.
there's a question, since when the research department started covering Heng? If you're referring to Phillips, then it's today. I'd also like to point out that since Heng IPO'd in 2010, there's only been one other report on Heng, and that's just early this year by DBS. So there's not much coverage at all, and today is when we started covering Heng. Okay, thank you. That's it for today.
Yep. Hi, this is Lucas here. As per all, here on we will send you the slides after the presentation. Yep. Thank you.